This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, at the end of the previous session together, I left you with a few examples for you to work through and hopefully agree the answers to with the model answers in the back. And it's those model answers that we're looking at now. And what the issues were, we were given a figure of a capital gain here, and we had to work out from the capital gain less the AEA to get the taxable gain. Important lesson there. What do they give you? Do they just overtly give you the taxable gain, or do you have to work that out for yourself, such as you did in fact, all of these examples I set for you? Once we know the taxable gain, however, we still don't know what the tax rate will be. For that, a couple of things need to be sorted. Firstly, off the income tax computation, where we were told trading profit 20, we were given the income, we had to work out the taxable income, we had to deduct, therefore, the personal allowance. That told us taxable income 9,000, basic rate band 32, taxable income 9, remaining basic rate band 23. We had a taxable gain of £6,900, so the lower of the lower or higher rate would apply. We also then had to realise that this was not residential property, nor was it an asset that qualified for entrepreneurs relief. So, not that that would have been applicable, not would have been an issue rather, because it would be 10% anyway, but the lower of the normal rates is 10%. So a CGT rate of 10% is applied, and that's what gives us our tax there. And again, the standard due date for this tax year, the following 31st of January, i.e. 2018. On to example 3, same basic issue there. Work out the taxable gain, you had to deduct the AEA. Work out the taxable income, you had to deduct the personal allowance. Work out the basic rate band remaining. This time with taxable income of 30, there was only £2,000, therefore, of basic rate band remaining, and we've got taxable gains of 18,900. Check out then what assets, well, it's other assets. It's not the residential property, it's not the entrepreneurs relief qualifying assets. 2,000 the basic rate band, that's 10%, up into the higher rate, 20% for the remainder of the gain. And again, our job is done. That issue made a little bit more interesting in terms of example 4, where though again, you had to work out the taxable gain and you had to work out the taxable income. What made this one more interesting was that with a taxable income of £34,000, you would have thought that the taxpayer was already a higher rate taxpayer. But not so, because in fact the basic rate band limit has been extended to £35,000. That was because there was a gift aid payment made during the year of £2,400, which is grossed up times 100 over 80 to 3,000, added to 32, extending the basic rate band limit to 35. Therefore, with a taxable income figure of only 34,000, it leaves 1,000 of the gains within the lower and the remainder of the gains within the higher rate. What rates again as other assets, 10 and 20% respectively. Now, until this point, all of the gains were on single assets where they were other assets and the 10 and or 20% rates were applicable. What we then found in example 5 is that we had to separate out the gain on the property from the gain on the ring, because the property now was residential property and therefore the higher residential property rates would apply. That would mean that had there been any losses, but as there is an AEA, that is deducted firstly from the gains to be taxed at the higher rates. That, of course, is going to be the residential property. So in which case, we've got here taxable gains of, we've got gains of 30,000 and 8,000 respectively, AEA 11.1, and therefore the taxable gain 18.9. What do we say in note 1 here? Deducted firstly from the gain on the residential property, as it would be subject to the higher CGT rates of 18% and 28%, whereas the gain on the diamond ring would only be subject to 10 and 20, there, the lower rates. The higher rates are applicable to residential property. So that is an essential deduction to apply the AEA, and had there been any losses, against the gains taxed at the highest rates. Residential property, if it exists, is always that one. Okay. We were told the taxable income of gainer, we were told the income was 21, we had to deduct the personal allowance, and therefore get a taxable income of 10. Unused basic rate band of 22,000, no reference to any personal pension contributions paid, nor indeed to any gift aid payments made, so no extension of the basic rate band. So with £10,000 of taxable income, a £32,000 basic rate band, we've got a remaining basic rate band of £22,000. The property gain is less than 22, so it all falls into this lower rate of 18% there. That's the lower rate for residential property, that is. It still leaves with £22,000 of remaining basic rate band available there prior to this gain being taxed. It still leaves £3,100 of the basic rate band available there to then go against the gain on the ring, and that's a 10% its lower rate. So the £4,900 worth of taxable gains that are up in the higher rate band is therefore deemed to be the £4,900 pertaining to the ring. Now that said, we've made the point here. Once you've correctly deducted any capital losses and the AEA from those gains suffering CGT at the highest rates, so that was what was important. Here it was just AEA, but otherwise losses as well. They must be deducted from those gains subject to the higher rate. Then routinely I would just tax the taxable gains in that order. Residential property before other assets, in turn before assets enjoying entrepreneurs' relief. However, once you've correctly deducted any capital losses and the AEA from those gains suffering CGT at the highest rates and computed the resulting taxable gains, it won't actually matter whether you do tax the £18,900 first, as we did, or whether you tax the £8,000 first. Because the point is that there's a same 10% differential in tax rate between the lower and higher rates. So here what would happen if we turned it around and taxed the gain on the ring first? All the 8,000 would be in the lower rate band, 10% would apply. That would still leave 14,000. Remember, we had £22,000 of basic rate band available. It would still leave 14,000. Then, for the residential property to be taxed at 18%, and the balance of the gain on the residential property is up into higher rate, which would be at the higher rate of 28%. And if you put those calculations together, as you'll see there, you still get exactly the same figure of CGT. Now, although, as I've said, it doesn't matter which order you tax the taxable gains, it was very important in terms of the order in which you made the deductions in deriving those taxable gains. But from now on, we'll do it in that order anyway. We will actually tax those gains taxed at the highest rate first of all. But again, overall, it doesn't matter. Okay, let's take you back to the notes now and pick it up again from where we had left off last time. So we move on to section 1.8. Again, to begin with, nothing that you don't already know, except that where we use market value, should an asset be gifted, then they would usually tell you, they've got to tell you what the market value of the asset would be, except in one basic situation of dealing with quoted shares, where you're expected to know what is a valuation rule, but a very simple one. So what are we told here? Actual consideration is used when the bargain is made at arm's length. So you sell to a third party, you get what you think is as full value as possible. That is the actual proceeds to be used in your gains calculation. What we don't do is to come back later and say, well, we think you could have got another £1,000 or £2,000 for that, so we're going to tax you therefore as if you've got those higher proceeds. No. If you've done what you thought was the best deal you could do to a third party there was no attempt to sell at an undervalue to this person because of your relationship with them, you've done a bad deal. HMRC do not add insult to injury, saying, ooh, look at you. You could have got an extra £2,000 for that. And I tell you what, we'll now tax you as if you had got that. No, they don't do that. But if we are gifting away, we are overtly selling at undervalue, given the relationship to the person that we're selling to, then we will always use open market value to compute the gain. But when quoted shares are involved, rather than telling you what the market value of the shares may be, they may give you a little exercise, and it is a very little exercise. When quoted shares are gifted, the value may not be given in the exam and should be calculated as the mid price based on the day's quoted prices given in the question. What they will do is to give you closing prices at the end of the day upon which the transaction took place, and they will tell you what they call a bid and offer price. There doesn't matter what they are, you're never going to have to use them in any other way other than take the mid price, a simple average of those two figures. So if we're told here that Jenny gifted 1,000 shares, they were quoted at £4 stroke £4 and 8p. A simple average of that is £4 and 4 pence, and the 1,000 shares would therefore be taken at that particular price. You're expected to know you don't use the lower, you don't use the higher, you just do a mid price, a simple average thereof. So a simple valuation rule. Otherwise, if it's a sale under value, they're going to tell you what the market value of the asset is, and they will do that. Moving on, stuff we do know about. Selling expenses, incidental costs would include legal fees, agency fees, auctioneers, any other advertising fees to be able to sell the property. Of course, they're all legitimate selling expenses deducted in deriving net proceeds. What about your overall allowable cost? Obviously the cost of acquisition along with any incidental costs of acquisition. So if you buy a property, there will be legal expenses. Those legal expenses are another part of the cost that you incur. Depending on how much you pay for the property and whether that property is either commercial or residential, there's a tax that, don't worry, you don't need to know how to calculate it in any way, but it's called stamp duty land tax, SDLT, stamp duty land tax, that would be payable. Well, that's another cost of acquisition and therefore would be deductible in deriving any chargeable gain that arose upon its disposal. So the cost of acquisition, usually what you paid for it. If of course it was gifted to us, then it would be deemed acquired at its then market value. Between when you bought or acquired and when you now sell, you may enhance the asset. You may incur improvement or enhancement expenditure, and that too would be an allowable cost. So having got your net proceeds, having got your allowable costs, we deduct the costs from the net proceeds, and usually, and we hope, to see a chargeable gain. But of course, we may have losses. Now, all we know about at the moment is that in the current tax year, you must net out any gains and losses of the year. So, as it's written here in section 2, part A, if you've got capital losses arising, they must be set against gains in the same tax year. Now I say they must be, you can't pick and choose. The set-off is made to the maximum possible extent. All of the loss against all of the gains. You can't here, oops, those pages are going flicking by. You can't here restrict it in any way. So you must therefore use all of the losses against all of the gains. It cannot, why, I said there, it can't be restricted. Why would you want to do that? Well, for example, to avoid wasting the annual exempt amount. It cannot be restricted to avoid wasting the AEA. So, for example, if in this year to date I had made gains of, let's just do this on another little, find a space here, bear with me. Let's say during the current tax year, so I'm going to go on to look at probably 3 tax years. So let's say in the first tax year that we are called upon to deal with, we're told that at this point in time the taxpayer had made gains of £10,000, had so far in the tax year made gains of £10,000, and was then considering making a further disposal before the 5th of April at the end of the tax year, but that would sustain a loss of £8,000. What advice would you give about the timing of that disposal? i.e., should he or she, as planned, should the taxpayer sell that, yield that loss before the end of the tax year, by the following 5th of April, or should the taxpayer keep that asset, subject to any commercial or practical issues about is that asset going to continue to go down in value, and by keeping it longer you'd make an even bigger loss, which clearly commercially is not a sensible thing to do. But if it's going to stay the same, then what should you do? Sell before the end of the tax year or sell at the beginning of the next year? What do you think? Now you think about it. If you do not use all of your AEA in any tax year, it's wasted. You cannot preserve it. And you cannot choose to not offset losses in the tax year in which they arise against any gains. They must be set off. So at the moment, your net gains are £10,000 in the tax year. Would you pay any CGT on gains of £10,000? Answer, no, you wouldn't, because £10,000 is less than the AEA, so you have no taxable gains. So if what you did was to dispose of the asset that gave rise to the loss, that loss being £8,000, all it now means is that your net gain is £2,000. That is still lower than the AEA. You pay no tax. In which case, you have got no benefit out of that loss. All the loss has done is to reduce gains by £8,000, £8,000 of gains that would not have had any tax to pay on them anyway, because as part of the £10,000 it was covered by the AEA. So that outcome is not very good. You are wasting that loss. So what we should do here, therefore, is leave it as it was. With the gains of 10,000, there will be no tax to pay. Gain 10 less AEA, nil taxable gain. And then wait until the second tax year to sustain the loss. So what advantage is that? Well, one, if there were going to be much bigger gains in the second tax year, then you'd be able to offset the loss of 8, hopefully against gains that would have been above the level of the AEA, and therefore get use out of that loss. But what I'll tell you here to illustrate the techniques involved is that, in fact, that is the only disposal made in the tax year. So if it's the only disposal made in the tax year, you've got a net loss for the year of 8,000. That is not wasted. It is now carried forward. It's carried forward into what for us would be the third tax year. And I'll tell you this about the third tax year. This time there were two disposals. One which gave rise to a gain and one which gave rise to a loss. The gain was 15,000 and the loss was £1,000 there. Right, how do we then deal with that? First thing that you must do is always, whatever the numbers, to net out the gains and losses of the year. Net gains, 14,000. And whether that loss there was 1,000 or 10,000, you must net it out, as we saw in our discussion about the first tax year. Here, though, it was just £1,000. Having got the net gains of the year, we are then able to, and will then deduct, less losses brought forward. Now, here's the thing. and it's now good news from HMRC. Remember, the losses brought forward are deducted before the AEA. We'll just use our standard rate of 11,100 as being applicable in all of these tax years. There's 11,100 to deduct, and we've got £8,000 worth of loss brought forward. Good news, as I said. We are now allowed to deduct the figure of loss that we would want to use in this tax year. So we do not have to, nor will we, apply all of that £8,000 loss now brought forward. Think, you want to leave sufficient gains to cover the annual exempt amount to give you taxable gains that will be zero, nil taxable gain. Therefore, what of the 8,000 loss brought forward would I now wish to use? And that's exactly what you're allowed to do and will do. If we therefore use 2,900, that will bring, I hope if my mental arithmetic is right, our gains down to 11,100, sufficient to be covered by the AEA, and therefore we give you nil taxable gain and no tax to pay. And what it would now mean is that out of that 8,000 loss that was brought forward, we've now used 2,900, so we still get £5,100 worth of loss to carry forward to the next year. So when those losses are carried forward, they're never going to be wasted, because they will only be used against net gains in those future tax years that would be in excess of the AEA. So very good news when it comes to the use of losses brought forward. Whereas with losses of the year, there's no choice. You must net out all of the gain against all of the loss of the year. And should that take you below the AEA, too bad. You will waste, therefore, some of those losses accordingly. Whereas with a loss brought forward, you will only use them in a future tax year if the net gains of that future year exceed the then level of the AEA, but you'll only have to use so much of the loss brought forward as would bring down the net gains of the year to the level of that year's AEA. So good news there, therefore. Alright, now with that in mind, let's just go back. We have, as luck would have it, a little example there where we've got Fiona and Jane, and you've got to calculate taxable gains for Fiona and Jane for both 15-16 and the 16-17 tax years, and the amount of any losses carried forward. So put into practice what I've just shown you there, please, and then check out with the answer in the back. So pause for a moment while you do that, then rejoin us again once you've checked your answer. Well, now having seen how to compute gains and losses for a taxpayer in a tax year, how we then bring together those net gains or net losses of the year, and if appropriate then go on to deduct losses brought forward and then to deduct AEA, we get the taxable gain. Then dependent on the type of asset that you're dealing with, though more to be learnt here as regards, for example, what disposals will rank for entrepreneurs relief. But as soon as we've seen what type of asset, and we've also established from the income tax computation the level of taxable income, i.e. are we already a higher rate taxpayer, or is there still some basic rate band remaining, all of which is from the income tax comp, we're then in a position to take those taxable gains, tax them at the appropriate rates and compute the CGT liability, and advise our taxpayer that that amount will be payable the following 31st of January after the end of the tax year. Well, what we've now got to do is to look at specific circumstances in which disposals take place, where there are specific rules that need to be applied. And the first of these is where we see assets, chargeable assets, being transferred either between spouses or between civil partners. Now, if you think back to our income tax computations, we saw there that each individual would have their own income tax computation from the day that they are born. so that when dealing with spouses or civil partners, each would have their own income tax computation, each would have their own personal allowance, their own basic rate band, and then up into higher rate. And if they, or one or either or both of them, owned income producing assets, we looked at the possibility of transferring in full or in part the ownership of that asset from one spouse to the other. Why were we looking to transfer the ownership of an asset from one spouse to the other, this income producing asset? Well, I hope you remember, it was some very basic and important planning. If a higher rate taxpayer is receiving such income, but their basic rate tax paying spouse has basic rate band available, then if we moved that income producing asset from the ownership of the one spouse to the other, then rather than having, say, like with property income, non-savings income, rather than having the income taxed at 40%, it could be taxed at 20%. If the transferee spouse had such a low level of income that they weren't even yet using up their personal allowance, then it's even better. You could move income from a basic or indeed a higher rate taxpayer to the other spouse who on some of that income, it being covered by their personal allowance, wouldn't pay any tax at all. So you'd be saving tax at 20 or 40 to then have tax charged at 0% because the income would be covered by the personal allowance. Clearly significant tax savings could be achieved. What we've now got to consider is that where a transaction is enacted or considered to be enacted, we've got to think through the whole process, not just in terms of the implications for one tax, but for all taxes. And the first of those taxes here, extra taxes to consider, is capital gains tax. If the asset, as it probably would be as an income producing asset, something like a property, if that is being transferred from one spouse to the other, how do we deal with that from a capital gains perspective? Because that's a chargeable disposal. If it's a chargeable asset, then gains should be computed, either using the market value there, which would usually be the case, or the sales proceeds if they represent a full market value. So, what therefore happens when these transfers are between spouses or civil partners? Are we, in trying to reduce our income tax, going to create a CGT liability as a result? And the simple answer to that is no. The rule: the transfer of assets between either spouses or civil partners is for CGT purposes deemed to take place at a value that would give rise to neither a gain nor a loss. It's said to be, and you can use either of these terms, a nil gain, nil loss transfer, or as I will use from now on, no gain, no loss transfer. A no gain, no loss transfer. So if husband transfers an asset to wife or vice versa there, irrespective of any sales proceeds that may or may not exist, it is said to be done at a disposal consideration that gives rise to neither a gain nor a loss. Now that means very simply that the transferor is deemed to make the disposal at cost. The transfer is at cost, the cost to the transferor. The transferee is then deemed to acquire that asset at the original cost of the transferor. Now this is not a claim, it's not an election, it is a rule. If the spouses or civil partners have chosen to transfer an asset from one to the other, then this is the way that it's done. There are many claims and elections that exist in tax, most notably indeed in terms of CGT, but this is not about choice. This is a rule. It will apply should the spouses or civil partners have decided to make a transfer between them. So it'll go at the transferor's cost. So here, calculate any capital gain for Gollum, or Frodo indeed, in 2016-17, where we're told Gollum had bought a ring in July 93 for £12,000. Gollum transferred it to his civil partner Frodo in December 16, so in our 16-17 year, when its market value was £20,000. We now, at that point, recognise as a transfer between civil partners, the transfer takes place for CGT purposes on a no gain, no loss basis, i.e. it is transferred at cost. So we ignore the fact that its market value is now 20, and we have a cost there of £12,000, and that is the figure that now we use. It goes at cost. So Gollum has a deemed disposal consideration of 12, a cost of 12, so neither a gain nor a loss arises. It's a no gain, no loss transfer. And civil partner Frodo is deemed to have acquired at that figure the cost of £12,000. So the transferee cost is the cost of the transferor. It's been acquired by Frodo at a deemed cost of £12,000. Now that is relevant because of what then happens. Frodo then sold the ring in January 17, this being to a third party, for net proceeds of £20,000. So in this tax year, Gollum has made neither a gain nor a loss. The asset's been transferred to Frodo at cost. It is then Frodo who has sold to the outside world and yield the gain thereon. What will Frodo's gain be? Disposal, sale proceeds £20,000, cost £12,000. Frodo has a gain of £8,000. So understand who is making the gain. Gollum makes neither a gain nor a loss, and the asset goes at cost of £12,000. It is Frodo acquiring at 12 and then selling at 20 who makes the gain in the year, that gain being £8,000 there. Okay, now as we've said, that is a rule. So there's no issue here about you choosing what basis to use to compute the value of the transfer. It goes at cost, it is no gain, no loss. But the fact that these no gain, no loss transfers do and will apply does actually leave us with an opportunity to use no gain, no loss transfers to improve the tax position of the spouses or civil partners, i.e. to reduce what would otherwise have been their overall joint tax liability. So these no gain, no loss transfer rules may be used by the taxpayers. How? To utilise the AEA of both parties. Why have a gain taxable in the hands of one when it could be covered by the AEA of another there? And to take advantage of capital losses and lower CGT rates. If one of the taxpayers has a loss brought forward, let that taxpayer yield the gain, and therefore reduce what might otherwise have been a taxable gain. If one taxpayer is a higher rate taxpayer and the other is a basic rate taxpayer, let the basic rate taxpayer yield any taxable gain. So the best we can do is to not pay tax at all as a result of the no gain, no loss transfer, moving it from a spouse who would have been taxed to a spouse who won't be taxed. And if tax is to be paid, let it be payable at the lowest tax rate. So here are our objectives. If we can, let's get gains that would have been taxed exempted, i.e. covered by the AEA, and any gains that otherwise would have been taxable, let them be taxed at the lowest tax rate. So let's just give you a little example to illustrate, therefore, that basic principle. Right, I'll tell you this information about our taxpayers. Now, we've dealt with that one. You can review the answer to Gollum and Frodo again in the back, but we've already discussed it. Right, I will now tell you information about husband and wife. Right, husband, we're told, has taxable income of 20,000. Wife has taxable income of 50,000. So what do we see from that? Husband remains a basic rate taxpayer and has basic rate bands still remaining. Wife is already a higher rate taxpayer. And what we're told is, by our clients, the husband and wife here, is that wife plans to dispose of 3 assets in the current tax year, each of which will yield gains of £10,000. So the wife plans to dispose of 3 assets in the current tax year, each of which will yield gains of £10,000. So here we've got the husband, who's a mere basic rate taxpayer, wife is a higher rate taxpayer, and she's the one with the assets that are about to be disposed of, so she plans, 3 of them, each of which will yield gains of £10,000. Righty-ho. So, at the moment, what would happen? So the current plan is that she will sell all 3. 3 times 10, her gains will be £30,000. She will have her AEA of 11,100 to deduct, and therefore she will make all of the taxable gains, and those taxable gains will amount to, what are we there, £18,900. £18,900 there. She is a higher rate taxpayer based on her taxable income. Assuming that the gains that we're talking about here are not on residential property, nor on assets qualifying for entrepreneurs relief, those taxable gains will therefore be taxed at, what is the higher of the 2 rates? It's 20%. So 18,900 therefore taxed at 20%. So 1890 times 2, what are we looking at there? That's going to be what, £3,780, methinks. But I would ask you to check through that to make certain that, that you agree with it. But she is a higher rate taxpayer. She will therefore, on those assets, pay tax at the higher rate of 20% rather than the lower rate of 10%. Okay, let us see by how much we could improve this position if we were to use, prior to the sale to the outside world, if we were to firstly use no gain, no loss transfers. So at the moment, she, as a higher rate taxpayer, is making all of the gains, and what exceeds the AEA is taxed at the higher rate of 20%. So what should happen to mitigate the tax liability, and what tax saving, very simple measure of tax saving, could be employed here, and what tax saving could be achieved? Right. How many of those assets out of the 3 do you think she should transfer to her husband prior to then the husband selling to the outside world? Now, I'd hope you'd realise that she would at least want to keep one of those assets to use her AEA. If she keeps one and sells that, covered by the AEA, there will therefore be no taxable gain. Equally, the husband should at least sell one of those 3 assets, because that would then utilise his AEA, or at least most of the 11,100. So each should sell at least one, but there's 3 of them. So which, therefore, that third one should be sold by whom? So what we've now done is we've looked to use annual exempt amounts. If we can get gains that would have been taxed, not taxed at all, that's as good as it gets. But if gains are to be taxed, let them be taxed at the lower of the available rates, that here being 10% rather than 20%. He is the basic rate taxpayer, she is the higher rate taxpayer. So I hope that you are now seeing that our plan here should be, she keeps one of the assets and sells it to the outside world. She makes a gain of 10,000, covered by her AEA of 11,100, no taxable gain, no tax to pay. And then 2 of the assets are transferred across to the husband, which he then sells to the outside world. So the husband would now have gains of £20,000. He has his AEA of £11,100. That leaves him, therefore, with the only taxable gains being made by the married couple here, and he's got £8,900 worth of gains. He has got sufficient basic rate band still available for all of those gains to be taxed at 10%. His taxable income up here is only 20,000. His basic rate band limit, 32,000. Taxable gains, only 8,900. So that 8,900 will have to be taxed, but it'll be taxed at 10%. 10% of 8,900 is £890. Look at the difference, therefore, in tax charges. That our intervention prior to the disposals taking place, this must, of course, we can't come along after the event and say, well, we'll pretend that you sold 2 to your husband, transferred 2 to your husband, and then he sold to the outside world. No. This must actually happen. Therefore, prior to the disposal to the outside world, she transfers on a no gain, no loss basis those assets to her husband. He takes at whatever the cost of those assets was, so it is him that generates the gain instead of her. By him generating 2 of the gains, £20,000, majority of the gain is again covered by AEA, and leaving the balance of £8,090 within his remaining basic rate band limit, and therefore as an other asset, it's taxed at 10%. Look at that saving. 3,780 is down to 890, a saving of nearly £3,000 just by a simple utilisation of no gain, no loss transfers between the spouses prior to a sale to the outside world. And we've there achieved our 2 objectives: to move gains that would have been taxable to not being taxed, i.e. utilising each spouse's AEA, and then any gains this year that are taxable to get them taxed at the lowest available tax rate. That's his rate here of 10 rather than hers of 20. Now, in fact, if we were more flexible as regards when these assets were to be sold to the outside world, if they could be sold independent of one another, then we could have reduced the tax down to 0 by simply saying transfer 1 to the spouse, to the husband this year, he sells 1, she sells 1. So just sell 2 of the 3 assets this year, each gain of 10,000 covered by their respective AEA figures. And if either would have next year an unused AEA, simply sell the 3rd asset next tax year and utilise that spouse's AEA. Therefore, no tax would be payable at all. In that way, you'd save all of the £3,780. Now, the beauty here, therefore, about CGT and planning. Unlike with income, where you have income for the year and you cannot control it, you can't say to a company that pays you dividends, look, don't pay me any dividends this year, pay them all to me next year, or vice versa. You can't say to the bank or the building society where you have a deposit, pay me twice the amount of interest this year and nothing next year. You can't say to your employer, pay me half my salary this year and 1.5 times the salary next year, or vice versa. That is not possible. You can't manipulate in that way. because you don't have control over those sources of income. They are what they are. But with capital gains, you decide when to sell. You also decide, when you're looking at spouses and or civil partners, who should be selling to the outside world, because you have available the no gain, no loss transfers. So that gives a capacity here specifically, not just for individuals, but very especially for spouses and civil partners, to time disposals over tax years, move assets between one to the other, so that each year we enjoy our AEA. We use the AEAs of each year whenever gains arise, and if any year there's going to be gains in excess of the AEA, then we try to ensure that it is the spouse that is taxed at the lower rate who will have that gain, rather than the one, if there is one, who would be taxed at the higher rate. Basic planning, very simple planning provisions, but very significant tax savings could be achieved from those very basic plans. Good. Let's just go back, therefore, and look at the note that we're working with. We've dealt now with Gollum. We've seen how a rule, a no gain, no loss asset transfer rule, can actually be used by taxpayers to their tax advantage, as we said, to move gains out of taxability or into a lower tax rate of taxability. What we now do is to look at some more unique and interesting scenarios in terms of how disposals might occur. And we'll do just one of those in this particular session, where we look at a bit of a giveaway by its name here, and that is, we're dealing with a part disposal. Now think, a part disposal. What's going on here? Now the idea is a simple one. We buy an asset and therefore know the original cost of that asset in its entirety. But at some future point, instead of selling the entire asset, we then sell just a part of that asset. Now, what information do we need to compute a gain? You need to know the sales proceeds. Not a problem. You'll know the proceeds when the asset is sold. You need the selling expenses. You will know the selling expenses when sold. Your problem is with the cost, because what you know the cost of is the cost of the entire asset, but you are only selling a part of that asset. So what proportion, what fraction of the original cost should we now expend, should we now allow against this part disposal? Now here, it's not about common sense, it is about, there is a rule. We must learn that rule and apply it. But it's a fairly straightforward one, you'll be pleased to hear. So, a chargeable asset may be only partly disposed of. For example, a taxpayer, best example here, easiest one to look at, is something like land. Taxpayer buys 100 hectares of land and subsequently sells off 40 of those hectares. Now when those hectares are sold, 40 out of the 100, as I said, you will know what they are sold for, your proceeds. You'll know your selling expenses, you can get the net proceeds. The question is, what is going to be the cost figure? So as I've just said, it will give rise to a chargeable gain, computed in the normal way. A specific problem arises, however, regarding what figure of cost should be used in the gains calculation. Now, given the example I've used here, you might think, well, I know what fraction to use because you are selling 40 hectares out of 100, so I'll use 41/100ths of that original cost, given the quantity of land that was purchased, 100, and then sold, 40. Think again, because that, in fact, is not the basis used. Because instead of using a quantity-based apportionment, we must always apply a value-based apportionment here, for which other information must then be provided. So the idea here is that the cost of the whole asset, we will know how much in this example we paid for the 100 hectares, is apportioned by multiplying it out by the following fraction in order to now compute the allowable cost of the part now sold. So we're going to go this ridiculous idea, fraction A over A plus B times cost. What does that represent? Simple. A is the gross proceeds for the part disposed of. So whatever are the gross proceeds in this example of the 40 hectares, that is the figure that would go on your top line. Over exactly the same figure, those gross proceeds, plus then a figure given in the question. B here, the market value of the remainder of the asset at the time of the disposal. That will be given in the question. How we refer to this fraction is its sales proceeds over sales proceeds plus value remaining. Now in most texts, they then go this A over A plus B and then tell you what A and B stands for. So learning A over A plus B is no use to you at all if you don't know what they stand for. So it is sale proceeds over sale proceeds plus value remaining. All of which information is given in the question. You simply have to pull it from the question to work then your answer. Now let's see how this works with our little example 9 here. Right, we've got to calculate the chargeable gain. We've used again land on the disposal of the 2 hectares of land in December 2016. Right, what are we told? ST owned 10 hectares of land, the original cost £26,000. In March 2024, sorry, that was when we bought it. But then ST sold 2 hectares in December 16 for £16,000. The remaining 8 hectares, here's your value remaining, were valued at £34,000 in December 2016. Right, the gains calculation. Do we know how much these 2 hectares were sold for? Of course we do. Sold the 2 hectares for £16,000. So the sales proceeds, £16,000. Had there been any specific selling expenses, they would be given to you, and you would therefore be able to deduct them in getting net proceeds. Not an issue here. But then the cost-based calculation that we perform. The cost. The original entire cost, we're told, was £26,000. So 26,000 times. We now use our value-based apportionment. On the top line, 16,000. Over a bottom line, 16,000, the sale proceeds, plus the value remaining. What is the value remaining? £34,000 plus 34. So we multiply that out, so get your calculators out, 26,000 times 16 over 16 plus 34, so it's 16/50ths there. Work out what that comes to. And all being well, if I've got my arithmetic correct anyway, I made that £8,320 worth of allowable cost, 8,320. Take away from your proceeds, and you were therefore looking at a chargeable gain of £7,680, and the job is complete. So that therefore is a part disposal. It's a value-based apportionment of the original cost to know how much of it should now be expended against this part of what was the entire asset originally purchased. Now that again is a well-worn example, and of course, as we keep saying, with objective testing questions in section A, it's a very easy object for an examiner of an exam question. It doesn't have to come up in probably what will be a separate 10-mark CGT question, probably in section B. But even then in section B, this could be one of the disposals made by the taxpayer due in the tax year, and would be, again, we put some selling expenses in there. It's a good 2-mark question for you. So there's our chargeable gain. If we wanted to complicate things just a little bit, and it probably won't happen, but it may, so be aware, is what might happen in an exam question is you're told that these 2 hectares were sold some years previously. So this gains calculation was a gain that arose in an earlier year and has already been taxed, so we don't need to know that. But what is now happening is that those remaining 8 hectares are now being sold. So again, you'll need to know the cost. So how do I work that cost? I have to go back to this original disposal and look back at that original cost calculation, because now I know that my original cost of the 10 hectares was that £26,000, of which this figure, £8,320, has already been used, has already been expended in the earlier gains calculation. Therefore, if I now sell the remaining 8 hectares, 26 was the total original cost, 8,320 has been originally used, take 8,320 from 26, that will be the amount of cost still available to go against now this subsequent disposal. And that, quick bit of mental arithmetic, 8,320 from 26,000, so that's going to be 8 from 26, 18, so £17,680, methinks, but just check that out, 26 minus 8,320. That will be the allowable cost of the part disposed of. So it's a slight variation on a theme. So you're not dealing with the first part disposal, you're dealing with the next part disposal. So think about that, therefore. Okay, have a look back through the work that we have done here, therefore, before next time, where in our next session together, again, continuing with these different circumstances where gains may arise, losses may arise, and there are separate rules, we then look at this area of chattels. Now, what you should already know about a chattel is its definition. It's a tangible movable asset, and that certain chattels, it's said in our list of exemptions when looking at a definition of chargeable asset, we said all assets are chargeable unless specifically exempted. And on that list we picked out, well, probably about 3 of the main ones that we picked out, but one of those was this certain chattels. Now, we do not know which certain chattels and what they are, and that they will be exempted, or what we also don't know is that there are in fact rules where a part of the gain may effectively be exempted, so we'll limit the gain in certain circumstances, or we'll limit the allowable loss. Those rules we will look at next time, and also seek to complete, indeed, this particular chapter on CGT. Look forward to seeing you next time.